Evan Sekeris, Assistant Vice President, Banking Supervision at Richmond Fed, talking in personal capacity and not representing the opinion of the Fed. So I have a few questions for you. So how would you qualify the main challenges that the AMA models present today in the industry? What are the
So first of all, I want to preface this by the fact that most of my views represent the U.S. experience and not necessarily the European one, because when I look at what European banks do, there seems to be a pretty significant difference between the models used here in Europe versus the ones that I'm used to seeing in the United States. In terms of the challenges, I would say that rather than starting with the challenge, I would say first that we've made a lot of progress with AMA models. If I compare things to where they were even 5 or 6 years ago, the LDA now dominates the field, whereas 5 or 6 years ago it was not clear that the LDA model was necessarily the most appropriate technique. There were many different banks were experimenting with different techniques. So at least we have that piece settled, and data collection obviously has been going on for a certain number of years, so the quality of the data and the quantity of the data is definitely significantly superior to what it was just a few years ago. Now, the challenges that are facing us right now, I would say, are mostly from a risk management quantitative integration perspective. So what you see, especially in ops, just much more so than in other risk dimensions, is that the models have evolved in their own silo in parallel with the risk management of operational risk. Because there is no tradition of operational risk modeling in the banking industry, it was really started because of the regulatory requirements. These models totally evolved on their own. And if you look at the models, they do not necessarily have factors built into them, so no risk drivers, and as a consequence, it's often very difficult to explain to the business side why the capital is what it is, and as a result, it's very hard for the business side to use that information for risk management purposes. So I would say that this is definitely the next big challenge. Scenario analysis obviously is an attempt at bridging that gap, but I think that the models themselves need to evolve in order for us to really get there. So once you start seeing models that are driven by risk factors, that will definitely help the dialogue between the two sides. So I'd say that is probably the big challenge right now.
The biggest challenge right now, yes. And what about stress testing? What your view of the shortcomings of stress testing is the size, and how should they be conducted to really prove their robustness and their reliability?
Stress testing in general, or stress testing specific to operational risk?
In general, let's say in general. Yes.
I mean, I'd say my first big concern with stress testing is what is stress testing?
Yes, good question.
I'm joking, but not entirely, because if you think about what people mean when they say stress testing, if you really ask them, you will see that many different people mean many different things. The FSA has its reverse stress testing requirement. In the US, we're running CCAR now, which is obviously a macroeconomic stress test. Other people will run stress tests as a sensitivity analysis tool, which is a mostly quantitative exercise where you choose one distribution instead of another, or you make some slightly different assumptions. But at the end of the day, those are very different things. And not only are they different in how you conduct the test, they're also very different in terms of what you do with the result of the test. So if I look at a more macroeconomic or stress test that tries to stress the factors driving the risk in a model, or stress testing more that's more like sensitivity analysis stress testing, those tools potentially will allow you to say things about the capital adequacy of your institution. Now, if I look at reverse stress testing, often it's very difficult to assign any kind of probability to those events. And in that case, my question is, how do I use that from a risk management perspective? And so, obviously, I don't think that these types of stress tests should be used for capital purposes, and they're not there to determine capital adequacy, but they should be used for risk management purposes. For example, if you realize during your scenario exercise that something, an event is more likely than you thought it was, and that your institution is ill prepared to deal with it, then some action needs to be taken. But so again, the stress test right now, to me, is still very ill-defined. A lot of work needs to be done in really refining the nomenclature of stress tests, and also the usage of these different tools to make sure that the different stress tests are used in an appropriate manner.
Yeah, make sure that you define properly the objectives of the exercise.
Before you run the exercise, because if your objective is to verify capital adequacy, well, then maybe you shouldn't be running a reverse stress test for that purpose, or use the results of your reverse stress test for that purpose. You need to know what you're doing. I mean, what you want out of a stress test in order to do it correctly.
Yeah. Okay.
Yeah.
Thank you
Great.
very much.
Thanks,
That's great.
Dominique.
Okay.